Hey guys, welcome back to our CA final revision series. So in this video, I will be revising the chapter Prospective Financial Information and Other Assurance Services. So one of the most asked area from the students have specifically received the comment from the students asking me to revise this particular chapter since this was a newly added content in the new syllabus. So that's why many students have been asking it. So in this video, I will try to revise the entire content, whatever has been given under this particular chapter, Prospective Financial Information and Other Assurance Services. So if you remember in the last video, whatever we have done the revision, in that video, we have done with SRS, Standards on Related Services. Like in case as a chartered accountant, if you have been appointed to either perform agreed upon procedures or you have been appointed for compilation of the financial information, how you are supposed to do that engagement, that guidance is there under SRS. We have covered two SRS revision in the previous video. You can refer to that. So now, as a part of this particular chapter, as a part of this prospective financial information and other assurance services, we are going to revise SAE series of standards on assurance engagement. We are going to revise. So this chapter is going to be completely about three SAE series of the standards: SAE 3400, SAE 3402, and SAE 3420. Very conceptual standards, very interesting standards, at the same time important from the examination perspective. But first of all, let me try to explain. Before we go to that individual standards, first let us try to understand what is the scope of this SAE. So what does this SAE talk about? Standards on assurance engagements are related to what? So if you remember, Institute ICA has given four categories of the standards. They are SAs, then we have something called SRE, then we have something called SAE, then we have something called SRS. So we have seen SRS will become applicable when you are agreeing to perform, when you are appointed for an engagement of performing related services. SA, Standards on Auditing, will become applicable whenever you are conducting audit of historical financial information. Whereas SRE will become applicable whenever you are conducting review of historical financial information. So both the standards on audit and the standards on review engagement, they deal with historical financial information. When we are doing assignment related to historical financial information, then either SA will become applicable or SRE will become applicable. But sometimes, being a chartered accountant, some clients might approach us to do some work, to perform some engagement which is related to other than historical financial information. What is that? Other than historical financial information. Sometimes some clients come up to us with a specific objective. They want us to do some engagement. They want us to perform some work, not with regard to historical financial information. They might come to us and ask us to do some work which is related to other than historical financial information. So as a practicing chartered accountant, when you are approached by your client to perform some engagement where you have to work on future, where we have to work on other than historical financial information, then SAE will come into picture and these standards will give you guidance. See, when I say other than historical financial information, it could contain two things. One is it could be future financial information. When I say other than historical financial information, it could mean two things. It could be either future financial information or it could be even non-financial information. So as a practicing chartered accountant, when any client has approached you asking you to do the engagement where you have to work on either future financial information, or some client has approached you asking you to do some engagement on other than financial information, on some non-financial information you have to work, then SAE will come into picture and these standards will give you guidance. So under SAE series, they have identified three such engagements where we are doing some work relating to other than historical financial information, and how to do that engagement, that guidance has been given. Like if you pay attention here, we have SAE 3400, which is going to talk about if the client has came to you asking you to do prospective financial information, examination, verification of prospective financial information. This is future financial information. So if the client is coming to you and asking you to verify their prospective financial information, how to do that engagement, so that is covered under, that guidance is given under SAE 3400. Similarly, when some client has come to you asking you to give a assurance report on controls at a service organization, basically in this kind of engagement you are required to give a report on internal controls. That means this is such an engagement where you are working on non-financial information. SAE 3402 is going to talk about non-financial information. So when we are asked by a client to do some engagement which is a non-financial information, basically in that engagement we are required to verify the controls and give an assurance on the internal controls. So then SAE 3402 will come into picture. Then we have one more engagement where we might be required to report on compilation of pro forma financial information included in a prospectus. This is also something future financial information only. So we have three standards under SAE series. Out of that, two standards 3400 and 3420 are going to talk about future financial information, whereas one standard 3402 is going to talk about non-financial information. Okay, so we will take up each standard for our discussion and we'll try to revise it. So first I will start my revision with SAE 3400, which is going to talk about examination of prospective financial information. Now, first of all, what do you mean by prospective financial information? As I have simply told you, prospective financial information means a future financial information, the information which is about to take place, not the information which has already taken place in the past, the information which is about to take place, that we call it as future financial information. But as we all know, we don't exactly know what is going to happen in the future. So that's why always prospective financial information will be prepared on the basis of assumptions. Prospective financial information is completely based on assumptions. It depends on what will be possible actions, not actual actions. What could be the possible actions in the future? So because of various reasons, some entities are required to project their future financial information. If I have to give you a few examples why the entities might be required to prepare the prospective financial information, take the best example, listed companies. So when you have a look at the listed companies, if you follow the business news and all, so often you will see listed companies giving a projection. They will say next quarter our revenue will increase by 10%. Next quarter our net profit margins are going to increase by 2%. So next quarter our assets are going to be this much. So like that, we often see listed companies giving projections about their coming quarter. So basically, in those circumstances, the companies are preparing prospective financial information. Let me give you one more example, especially when clients need bank loans. Take for example, a client X Limited need a bank loan. So when they go to the bank asking for them for a loan, the banker will say, okay sir, we will give you loan, but we want you to do something. We want you to prepare projections. We want you to prepare something called projections, or some entities will even call it as forecast. So bank will ask you to project how the future will look like, because they need some assurance whether you will be able to repay that loan liability in the future or not. They need some assurance. So that's why what the banker will ask this company is, sir, you please bring the projections, then only we'll give you loan. So they are the management of the company X Limited. They are required to estimate how their coming future 5 years is going to look like. And once they submit that projections, then only the banker will give you the loan. So there could be n number of reasons why the entity might require to prepare the prospective financial information. That is not a matter of concern for us. But whatever may be the reason, whenever the client is required to prepare prospective financial information, then they will bring that prospective financial information to you. They will ask you to verify and certify that prospective financial information. They will ask you to verify and certify that prospective financial information. Now, as a chartered accountant, you are required to verify that prospective financial information. So basically, you are working on the future financial information. Now, SAE 3400 will pitch in and give you the guidance. But before we talk about SAE 3400 in a much more detailed manner, we need to understand prospective financial information categories. See, prospective financial information can either take up the shape of a forecast, or even that could be a projection. So prospective financial information can take up two ways, can take up two structures. Prospective financial information could be either a forecast or it could either be a projection. Now, what is the difference between a forecast and a projection? Forecast is something which is based on best estimate assumptions. Forecast is something which is based on best estimate assumptions, whereas projection is such a kind of prospective financial information which is purely based on hypothetical assumptions. Which is purely based on what? Hypothetical assumptions. See, let us try to understand what is the meaning of best estimate assumption and what is the meaning of hypothetical assumption. Let us try to understand. See, take for example, there is one company X Limited. Now this company X Limited, they are required to prepare how the next financial year's financial statements are going to look like. Next year's financial statements, how they are going to look like, they are required to prepare prospective financial information. Now what this company is doing is they have tracked the last 5 years of data. So on an average, in the last 5 years, the trend of the revenue is something like this. So in year 1 it was 100, in year 2 it was 120, in year 3 140, in year 4 it was 160, in year 5 180. So depending on this trend, they have estimated that the next year the turnover is going to be like 200. The turnover is going to be like 200. Similarly, they have one trend for all the expenses. So they have estimated on the basis of the past trend, and they have prepared that prospective financial information. So now I will call this as best estimate. This I call it as this turnover, whatever assumption management has made that they are going to make 200 crores of revenue in the next year. This is a best estimate assumption. Why best estimate assumption? Why? Because this is something which is having more chances to take place. This is something which is expected to happen 99% of the cases, or in majority of the cases. This is what actually will turn into reality. Why? Because these prospective financial information was prepared purely on the basis of proven track record. So this is most likely to take place. So these kind of prospective financial information, we call it as a forecast, which is a best estimate, and this forecast is most likely to take place. It will be most likely to happen. Now let me tell you another case. This company X Limited has approached a bank asking a loan for 10,000 crores. Now this company is asking this bank for an amount of 10,000 crores so that they can use this 10,000 crores in the purpose for starting one new venture. They're going to launch a new product in the market, and if that product if that product becomes successful, company is going to make a significant revenue. So now bank has asked them to prepare the projections for the coming 5 years. I will tell you immediate financial year's data. In the year which has just now completed, the data is something like this. The turnover of the company was 500 crore rupees. The profits of the company was 100 crore rupees, and total assets are somewhere around 700 crore rupees. This is what actually has taken place. Now what the company is doing is, in the coming 1 year, in the next 1 year, if you give us the loan of this 10,000, we will invest in one plant and machinery, and using that plant and machinery, we will launch one new product in the market. That product will become successful, and that revenue is going to, in year 1, our turnover will become 10,000 crores. And our profit will increase from 100 crores to 2000 crores. Our profit will be 2000 crores. Our assets will be 700 crores. Our assets are 700 crores currently, but if you give us the loan of 10,000 crores, we will invest all that money in the in acquiring that plant and machinery and all. Our assets will become 12,000 crores. Like that, they told in year 2 the product will reach even more people. In the next coming 1 year, the revenue will go to 20,000 crore rupees. We will make 4,000 crore rupees of profit. We will incur more capital expenditure. Our capital expenditure is going to be, our assets are going to be 15,000. See, here we call it as hypothetical assumption. So here, whatever prospective financial information management has prepared, that is not realistic. That might happen, that might not happen. But that is not the case when we have seen the previous scenario. In the forecast, we have made such assumptions which are most likely to happen. But here, these are all hypothetical assumptions. They might take place, they might not take place. So company is basically saying, if you give us loan, this could happen. Not this will happen. This could happen. Whether that will happen or not, it all depends. That could happen also, that could not happen also. So this is what we call it as hypothetical assumption. Clear, everybody? So whenever the entities are preparing prospective financial information, that prospective financial information can take up the shape of either a forecast, or it could even take the shape of a projection. Forecast is something which is based on best estimate assumptions, whereas projection is something which is purely based out of hypothetical assumptions. So whatever it is, an entity is coming to you asking you to verify either their forecast or their projection, and they're asking you to give an assurance on that prospective financial information. Now what you should do, how you should do that engagement. See, before we proceed further, how to do the engagement, first let us try to understand whether we should do that engagement or not. Whether are we supposed to do this engagement? If a client is coming to us and asking us to verify the prospective financial information, are we supposed to perform that engagement? See, why I am putting this doubt in your mind is because we have one clause in the professional ethics when we have seen the second schedule part 1 clause 3. Second schedule, part 1, clause 3, which says a chartered accountant in practice will be deemed to be guilty of professional misconduct if he allows either his name or his firm's name to be used in connection with the prospective financial information, which will create a belief that he is vouching for accuracy of the prospective financial information. So clause 3 of the second schedule strictly prohibits a practicing chartered accountant to use his name in connection with the prospective financial information, which gives a belief that he is vouching for accuracy. So there is a restriction? No. Yes, there is a restriction. But the thing is, you can associate yourself with the prospective financial information. You can use your name in connection with the prospective financial information, but you should make it sure that you are not giving a wrong belief that you are vouching for accuracy. That means you should clearly mention, I am just verifying here whatever assumptions they have made, whether it is reasonable or not. I am not giving any guarantee that this will happen into reality, that this prospective financial information will turn into reality. I don't give any guarantee. You have to clearly mention. So long as you don't vouch for accuracy of the prospective financial information, you can get happily associated with the prospective financial information. But however, you are using your name to be used with the prospective financial information in such a way that it is giving a wrong belief that you are vouching for accuracy, you will be deemed to be guilty of professional misconduct. So you have to be very careful when you are associating yourself with the prospective financial information. Please make sure that usage of your name with the prospective financial information is not giving any kind of wrong belief that you are vouching for accuracy of that prospective financial information. Clear, everybody? So that is what the comparative study of professional ethics and this standards on assurance engagement. Clear, everybody? Next. Okay, so we have seen all this. Next one more thing. Sir, what does this standard deal with? See, this standard will deal. What is the scope of the standard? In the scope of the standard, one thing we have to remember, SAE 3400 will become applicable only when you are working with the prospective financial information, which is in quantitative terms. So when you are working on the prospective financial information, which is expressed in numbers, then only SAE 3400 will become applicable. In case if you are supposed to work on some qualitative information, narrative disclosures. Generally, when you open the annual report, you will find something called management discussion and analysis. MDA paragraph you will find, MDA content you will find. In the MDA, management will make so many management will say so many things about their future in narrative terms, not in numbers. So we'll become the largest manufacturer of steel in the coming 1 year. So these are what narrative disclosures. These are not expressed in figures. So in case if you are working on narrative disclosures regarding the future, then SAE 3400 does not have any role to play. SAE 3400 will come into picture only when you are working on the prospective financial information, which is expressed in numbers. Clear, everybody? So that is one important thing which you have to remember when you are thinking about scope of this standard. Next. Yeah. So are you going to give any assurance when you're working on the prospective financial information? No, we are not giving any assurance that this prospective financial information will turn into reality. We are just giving a assurance whatever assumptions which the management has made, whether that is reasonable and whether this prospective financial information has been prepared and presented properly. Able to understand? So there is a thin line of difference. Often students get confused here. See, when we are certifying, when we are giving a report on prospective financial information, we are not giving an assurance that this prospective financial information will happen in the future. No. Our assurance is regarding whatever management assumptions have made in the preparation of that prospective financial information. Are they acceptable? Have they made acceptable assumptions? And whatever that prospective financial information is there, whether that is presented properly or not. Okay, so anywhere we are not giving any assurance that this prospective information is going to turn into reality. So that's what we have said here. If you read this, while evidence may be available to support the assumptions on which the prospective financial information is based, such evidence is itself generally future oriented and therefore speculative in nature. So whatever evidence you are getting regarding prospective financial information, even that evidence is also futuristic. That evidence could actually turn out into reality or may not turn out into reality. Therefore, an opinion as to whether the results shown in the prospective financial information will be achieved or will not be achieved, that we are not going to express. We are just going to express whatever assumptions which are made, whether they are reasonable, and whatever presentation and disclosure of the prospective financial information is there, whether that is proper or not. That is what our assurance is relating to. Okay. Next, sir, it is whose responsibility to prepare the prospective financial information? Management. As a practitioner, you are verifying whether that prospective financial information is appropriate or not. But it is whose responsibility for preparing and presentation of that prospective financial information? Management will prepare that prospective financial information. So they are responsible for preparing that prospective financial information. They are responsible for disclosing what assumptions they have made in the preparation of the financial statements and on what basis they have made the forecast and projection. So everything is management's responsibility. So preparation part is management's responsibility. And as a practitioner, when you are supposed to verify that prospective financial information which is prepared and presented by the management, then SAE 3400 will come into picture. So that's what they have said here. Management is responsible for the preparation and presentation of the prospective financial information, including identification and disclosure of prospective financial information. They are responsible for identifying what information they have to present and how they have to present. They are responsible for explaining on what basis these forecast and projections are prepared, and even in that prospective financial information they have to clearly state what assumptions they have made in the preparation of that prospective financial information. Even assumptions also they have to clearly list out so that users will understand. Okay, so this point I have already covered. Can professional accountant be associated with prospective information? Yes, so long as you don't vouch for accuracy. So this point I have also covered. Okay, now, okay, sir, I have accepted the engagement to do verification of prospective financial statements. What is my responsibility now? What are my duties? What I am supposed to do? What I am not supposed to do? So that guidance has been given now. So if you start looking at it, so in an engagement to examine prospective financial information like audit, here also you are responsible for obtaining sufficient and appropriate evidence. You are also required to obtain evidence. You are also required to obtain sufficient and appropriate audit evidence. Regarding what, sir? Number one, you need to obtain sufficient and appropriate audit evidence, whatever assumptions management has made. Whether that could be best estimate assumption or it could be hypothetical assumption. Are they reasonable or unreasonable? Are they acceptable? Are they unacceptable? Basically, we can't judge whether assumptions are correct or not, because assumption is something which we use where we can't measure something with accuracy. So they are also not asking you to obtain sufficient and appropriate audit evidence whether assumptions are correct, which we can't do, but whether assumptions are reasonable, are they acceptable, whatever management has made assumptions, are they acceptable or not. Regarding that, I need to obtain audit evidence, number one. Number two, I need to obtain audit evidence whether prospective financial information is properly prepared, whether presentation everything is proper or not. That also I need to obtain audit evidence. And one more thing, the prospective information is properly presented and all material assumptions are adequately disclosed. It is the responsibility of the management to disclose in the prospective financial statements what assumptions they have made and whether those assumptions are hypothetical assumptions or are they best estimate assumptions. Stating that is also responsibility of management. It is your responsibility as a practitioner to obtain audit evidence whether they have done that presentation properly or not. And then finally, you need to verify whatever prospective financial statements are there, are they consistent with historical financial information. Which means, for example, last year the year which got over was 23-24. Now in the year 23-24, actual financial statements are prepared, and in that actual financial statements we might have followed some accounting policies. Now whatever accounting policies the client has followed in the historical financial information, the same accounting policies should be even followed while presenting the prospective financial information. Like in the historical financial information, if the client has charged a depreciation on SLM basis, the same SLM basis of depreciation has also been reflected in the prospective financial information or not. That also I need to obtain audit evidence. So as a practitioner, to perform engagement of prospective financial information, my duties are I need to obtain sufficient and appropriate audit evidence regarding how many things? 4 things they have told. Number one, whether assumptions are reasonable or not. Number two, prospective financial statements are properly prepared or not. Number three, all the assumptions are properly stated or not. Number four, they are consistent with the historical financial information or not. As simple as that. Regarding these 4 things, I need to obtain evidence. Next, when a client has come to you and asked you to do the engagement regarding verification of prospective financial information, before accepting that engagement, before you say yes to that engagement, what things you will consider? Whether I should accept this engagement regarding prospective financial information or I should stay away from that prospective financial statements, how you will decide, what factors you will consider. So you will consider factors like what is the intended use, what is the purpose for which this prospective financial information is prepared. Whether the information will be for general or limited distribution. Will this prospective financial information will be distributed to everybody or it will be circulated only to limited audience? What is the nature of assumptions? What kind of assumptions are getting used? What are the elements which will be included in the information? In the prospective financial statements, what elements will be there? Will there be only balance sheet, P&L, cash flow statement, or will there be statement of changes in equity also? So what elements will be included? And for what period that prospective financial information is prepared? Is it prepared for 1 year, 5 year, 10 years, or how many years? So basically, you will consider all these factors. If you felt it is okay, then you will accept. If you find any of this unreasonable, then you will try to stay away from that prospective financial information. Sometimes what will happen is at the time of accepting the engagement, no objections will be there. But after you have accepted the engagement, then you realize that, okay, whatever assumptions management has made, they are unrealistic. Or the prospective financial information will be inappropriate. See, if you know it before accepting the engagement only, don't accept. Sir, but I have accepted the engagement. At the time of acceptance, I didn't find anything mischievous. But after accepting the engagement, I am feeling that assumptions are very unrealistic or prospective financial statements are very, very inappropriate. Then what I should do? I have already accepted that engagement, sir. Simply, what you should do is withdraw from the engagement. Withdraw. You have to withdraw. That's all. Next one. Right. And even here also, you need to draft the engagement letter and all the terms and conditions should be drafted in an engagement letter. As a practitioner, you prepare that engagement letter, give it to the client, ask the client also to sign it so that in future, if any misunderstandings arises, you can resolve that misunderstandings by way of having an engagement letter. Have here engagement letter as well. Next, what examination procedures you are going to perform? What exact procedures you are going to perform? So you are going to decide what nature, timing, and extent of procedures you are going to perform considering various factors. Like you can use knowledge obtained during any previous engagement. In case if the client has asked you to certify the prospective financial information, if you have already done any past engagements for the same client, if you have done that, whatever information that you have acquired as a part of past engagement, that you can use it in the prospective financial information verification. And also you should consider management competence. Are the management capable enough to prepare this prospective financial information? So if the management is capable, then you will decide procedures in some way. If you feel that no, management is not that capable, somehow they have prepared the prospective financial information, then you have to be more careful. You need to perform more procedures. And also likelihood of material misstatement. This in audit terms, we call it as risk of material misstatement. When you find that risk of material misstatement is high, more examination procedures. When you find that risk of material misstatement is low, lower examination procedures. And also how far the prospective information is affected by management's judgment. If more management judgment is involved, more procedures you have to perform. If less management judgment is involved, less procedures you have to perform. And also sources of information. From which source you are getting the information? Are you getting from a reliable source or not? If you are getting information from reliable source, okay, lesser examination procedures. If you have doubt regarding the source of information, more examination procedures you have to perform. And it even depends on stability of the entity's business, and also it depends on engagement team's experience. What is the experience of your engagement team? Have they done this kind of engagement earlier? If yes, you can be little bit okay. However, if your engagement is doing this kind of engagement for the first time, then you need to increase your nature, timing, and extent of examination procedures. So all these factors will be considered by the examiner, and accordingly he will determine what will be his nature, timing, and extent of examination procedures. Next one. Yeah, so these are all covered. These are all repeated points only. Next one, presentation and disclosure. So this is one more important thing. So as I have told, it is the responsibility of the management to prepare prospective financial information. It is the responsibility of the management to present and disclose properly the prospective financial information. So as an audit, as an examiner, my responsibility is to check whether management has really prepared and disclosed that prospective financial information in a proper manner or not. How I will get to know so whether management prepared and disclosed that prospective financial information in a proper manner or not? How I will get to know? So they are telling a few procedures, like number one, I need to make sure that whatever information they have presented, that is clear, not misleading. You need to particularly verify that prospective financial information is not misleading. And in that prospective financial information, accounting policies should be clearly disclosed. What policies they have followed, that should be clearly disclosed. And whatever assumptions they have used, that also should be clearly disclosed. These are all repeated points, more or less. And I need to check the date on which that prospective financial information was prepared. And after the management has prepared, till the time I verify has any subsequent events have taken place which require the management to revise their assumptions. So that extra information also I have to consider. And sometimes I will establish a range. Sometimes the management will prepare the prospective financial information on the basis of a range. So what do you mean by range? For example, management will say that next year when they are preparing prospective financial information, instead of stating one single figure, they might say revenue will be somewhere between $150 million to $200 million. So like this, sometimes the management might prepare prospective financial statements on range basis also. Not in exact figures, they might also present ranges. So in those cases, I need to understand whether that ranges are appropriate or not. And also, I told you that accounting policies should be consistent with historical financial information. In case if you find any inconsistency between accounting policies in the historical financial information and the prospective financial information, try to understand what is the reason why they have changed the accounting policy in the prospective financial information. So these are the few things which we need to particularly verify regarding presentation and disclosure. Understood? Next one. Next, after you are done with all the verification, then you are supposed to give a report. In that report, what contents should be there? What and all contents must be included in that report? Let us see. So first, there should be an appropriate title, an appropriate heading you have to give. Then you have to mention the addressee to whom you are expressing this assurance. Mention that addressee. Identification of prospective financial information. Tell that you are working on prospective financial information and what are the elements of that prospective financial information. Identify that. Give a reference to standards on audit applicable in case while conducting that examination of prospective financial information, if you applied any standards on audit, which standards on audit you have applied, give that reference as well. And also clearly state that management is responsible. You are not the person who prepared the prospective financial information. It is management who prepared that prospective financial information. Highlight that information also. Where applicable, give a reference for what purpose this prospective financial information is prepared and for whose distribution this prospective financial information is prepared. That also you try to mention in your report. And say that you have done that examination procedures on a sampling basis. Here also we do the examination on sampling basis. Tell that you have done the examination procedures on a sampling basis regarding the assumptions. And also here you have to give negative assurance. Sir, what do you mean by negative assurance? See, in audit, we give positive assurance. Like for example, in audit, if we are satisfied, we will say financial statements give a true and fair view. Based on information and explanation available to us, financial statements give a true and fair view. But in review engagements and also in assurance engagements, we say the same thing in a negative way. So we will say that based on information and explanation given to us, nothing has come to our attention which makes us believe that this prospective information is wrong. Able to understand? Here also I'm saying a positive assurance only, but in a negative way. In audit, we say things in a positive way. We believe that financial statements give a true and fair. But in assurance and review, what I do is the same thing. I will try to put it in negative terms. So I will say, based on our examination, nothing has come to our attention which makes us believe that this information is false. So basically, I'm trying to say this information is correct only, but the same thing I'm trying to put it in negative sense. So nothing has come to my attention which makes me believe that this information is wrong. So indirectly, I'm telling everything is correct only, but I'm trying to say it in a little bit negative way. So in assurance engagement also, we give negative assurance. Even in review engagements also, we give negative assurance. But in audit, we give positive assurance. We straight away say it. Next one. So give that assurance and then you have to express your opinion whether prospective financial information is properly prepared and assumptions are also reasonable or not. State your opinion and also appropriate caveats concerning the achievability of the results. Nothing but appropriate terms and conditions. Whatever assumptions management has made, are they achievable? Are they not achievable? That also you tell it. Basically, in the case of forecast, in the case of best estimate, they are achievable. In the case of hypothetical assumptions, they may be achievable, they might not be achievable. Then after including all the contents, mention the date, place the signature and place of signature. Along with that, you have to add your signature as well. So these are all the contents which must be there in the report which you give on prospective financial information. Next one, now talking about opinion. See, here they have given different kinds of opinion. This I will try to summarize it. Effect of opinion, this I will try to summarize it. Just give me a moment. So what they try to say here. See, number one, if you came to know that, so whatever that detailed paragraphs are there, simply I will try to summarize it. First thing, if you came to know that whatever assumptions management made are unreasonable, whatever assumptions management has made that are unreasonable, management did not make use of proper assumptions. Whatever assumptions management made, they are all unreasonable, wrong assumptions they have made. Directly you have to give an adverse opinion. Directly you have to give a what? Adverse opinion you have to give. Okay. Second case, assumptions are appropriate. Assumptions are appropriate. They have made proper assumptions only. But presentation, presentation and disclosure is not proper. Presentation and disclosure is not proper. Assumptions they have made properly only, but they did not present the financial statements in a proper manner. Then what you can do is either you can give qualified opinion or you can give adverse opinion depending on severity. Either you can give qualified or adverse opinion. In some extreme cases, you might be required to even withdraw as well. You might be even required to withdraw anyone, either qualified or adverse. This is what majorly we do, but in some extreme circumstances we might be even required to withdraw from engagement. Clear? Third scenario in which they say, if you are unable to perform procedures, if you are unable to perform procedures, if you are unable to perform examination procedures, you are unable to do your procedures only, then what you should do is, to the extent possible, you have to withdraw from the engagement. If a withdrawal is not permissible, then you have to give a disclaimer. Then you have to give what? A disclaimer of opinion. Clear? So this is what the reporting responsibility is. The same thing they try to say it in a very lengthy sentences, but this is what the summary. So if the assumptions itself are unreasonable, directly give an adverse opinion. Assumptions are okay, but there is a problem with the presentation, then you can give either qualified or adverse depending on materiality and pervasiveness, or in some extreme circumstances you might be required to withdraw from the engagement. However, if you are unable to perform examination procedures, you are unable to do that procedures only, then what you should do? You should either withdraw from the engagement or you have to give disclaimer of opinion. So that's what they have tried to explain in all these paragraphs. This you can refer it. Understood, everybody? Next one. Finally, whatever things you have done regarding this engagement and what evidences you have gathered, everything should go and sit in your engagement documentation. That's all. So this is what SAE 3400 talks about regarding how to perform engagement regarding examination of prospective financial information. Hope you guys are able to recollect the things in a proper way. Easy one. If you ask me, it is a very easy standard. So since we are successfully done with SAE 3400, now we will revise SAE 3402, which is talking about assurance reports on controls at a service organization. So as I have told, this is such an engagement where we are working on non-financial information. So basically we are trying to give assurance on internal controls. So we are working on something which is relating to non-financial information. Then also SAE series will give us guidance. And in this particular matter, SAE 3402 is giving us the guidance. But before we could understand what exactly is this engagement talking about, we need to have some background discussion. So we need to understand 4 terms: user auditor, user entity, service auditor, service organization. So these are 4 terms we have to understand. So this is more or less similar to whatever we have learned in SA 402. So first, let us try to spend some time in understanding these 4 terms: who is user entity, who is user auditor, who is service auditor, who is service organization. First, we will become familiar with these terms. See, take for example, there is a company Infosys. Now, this Infosys company is having their statutory auditor. This Infosys company is having a statutory auditor who are Deloitte. So Deloitte are the statutory auditors of Infosys. Now, this Infosys company, as we all know, this Infosys company is into IT business. They are providing IT services, in software services. Now, Infosys company will have various operations to look after. So the management of the Infosys company, they need to look after the decision making. They have to run the business. They have to maintain, they have to recruit the people. They have to pay the salaries. So like that, the management of the Infosys company need to take care of so many functions. But today, as we all are aware, outsourcing has become very popular. Basically, outsourcing means whatever functions which you are supposed to do, that you are getting it done by other person by paying some amount. So similarly, what Infosys thought is they are required, the management of this company wants to concentrate only on the business. They don't want to concentrate on the daily nuances. So what they thought is, so we management of this Infosys company, we will purely concentrate only on expanding the business. Whatever regular activities are there, that we will try to outsource it. So like that, what management thought is, let me outsource. The Infosys company wanted to outsource some of their regular functions to some other third party. Like for example, whatever their payroll processing is there, every month they have to pay the salaries to the staff. From the salaries, they have to deduct PF, ESI, all that things they have to do. So this is what we call it as payroll. So what Infosys company thought is, we don't want to held up in all this payroll related works. We will try to outsource that payroll related work to some outside entity. So we have one popular outsource service provider. So we have this entity called Genpact. So Genpact is one of the top outsourcing service provider. So Infosys company thought, okay, whatever our payroll activities are there, which we are expected to do, we will outsource that payroll services to Genpact. Genpact will handle payroll services on behalf of us. Similarly, they have outsourced AR, accounts receivable activities, whatever are there, that collection of money from the debtors on time. So that activity has also been outsourced to Genpact. They have also outsourced AP outsourcing, accounts payable also they have outsourced to Genpact. So here Genpact is providing outsourced services to Infosys. So here Genpact will be called as service organization. Genpact is a service organization which is providing that outsourced services. And Infosys is the company which is using the services of that Genpact. So here Infosys will become user entity. Infosys will become user entity. And the auditor, the statutory auditor of the user entity, we call them as user auditor. So in our example, Genpact is a service organization, Infosys is a user entity, and Deloitte are the user entities auditor. We call them as user auditor. Now this auditor, the Deloitte, while conducting the audit, so this Deloitte entity, they are required to conduct audit of financial statements of the Infosys, which comprises balance sheet, P&L, statement of changes in equity, cash flow statement, notes to accounts, like this. Whatever financial statements of the Infosys are there, those financial statements will be audited by Deloitte, and on that they will give an opinion. They will give a report in which they will express an opinion on the financial information. But auditors of the Infosys, this user auditors thought that, okay, our client company, our entity in our example, Infosys, they have outsourced various kinds of activities to the Genpact. Now, whether the Genpact is having proper internal controls to do these activities which are outsourced to them or not, Deloitte needs assurance. Deloitte want to make sure that whatever activities which Infosys, which their client has outsourced to that service organization, whether those activities are properly performed, whether there are proper internal controls at the service organization to do these activities in a proper manner or not, this Deloitte needs assurance. Sir, why Deloitte needs this assurance? Take for example, so here Infosys has outsourced their payroll activities. If the Genpact doesn't have proper internal controls for deduction of the PF, for deduction of ESI, and also whatever statutory obligations are there, if Genpact doesn't have proper internal controls to deduct PF, ESI and deposit with the regulatory authorities, ultimately the impact will not be on the Genpact financial statements. It is going to have an impact on the financial information of Infosys. Infosys has outsourced payroll activities to whom? To Genpact. But if the Genpact does not have proper internal controls while processing the payroll activities of the Infosys, it is going to have a direct impact on financial reporting. It's going to directly have impact on financial reporting of Infosys. So here, and also if you remember, that will have an impact on the Caro reporting. So in the Deloitte, while giving their Caro report on the Infosys, they will have a Caro report. In that Caro, clause 7 will be there. Statutory dues, whether a company is regular in depositing all the statutory dues with the respective authorities or not. So if the Genpact doesn't have proper internal controls while they are carrying out this outsourced activities, that is going to have a direct impact on user entities financial statements. In our example, Infosys financial statements. So that's why Deloitte needs assurance that Genpact is having proper internal control system to make sure that whatever activities that are outsourced to them, those activities are done properly. So regarding this, Deloitte needs assurance. So now how come Deloitte can do assurance? They can do one thing. So they can inquire. They can go and inquire the Genpact management. So dear Genpact, our client has outsourced the activities to you. Are you having proper internal control system to carry out that outsourced activities? Or what Deloitte can do is they can go and visit the Genpact. They can go and visit the Genpact and perform the test of controls to verify whether they're having proper internal controls or not. See, like this, Genpact is not just providing outsourced services to Infosys alone. There are so many clients to whom the Genpact is providing that outsourced services. So Genpact is providing outsourced services to Tata Motors also. They are providing outsourced services to TCS also. They are providing outsourced services to Maruti Suzuki also. So like that, Genpact is providing this outsourced services to many entities. Now these all companies also will have auditors. Now these auditors also needs assurance whether the Genpact is having proper internal control system or not. Now these auditors of these companies also might be required to visit the Genpact to verify whether they are having proper controls or not. If that is the case, the office of the Genpact will be flooded with so many user auditors. The Genpact office will be flooded with so many user auditors who wanted to verify the internal controls, whether they are doing their outsourced financial activities in a proper manner or not. That will be a major obstacle for their routine activities. So now what Genpact can do, sir, to avoid flooding of their offices with all this user auditors, what they can do? So what they can do is Genpact can appoint another auditor. Take for example, in our example, Genpact has appointed EY. So they have appointed EY. Who appointed? Genpact appointed EY. For what purpose? For the purpose that this Genpact will verify this internal controls. This EY is going to verify these internal controls which Genpact has implemented for carrying out the outsourced activities, whatever they have got from user entities, so that this EY will give a report on the internal controls. That report can be used by all these user auditors to determine whether this internal controls at the Genpact are working effectively or not, or whether internal controls at the Genpact are existing or not. So this user auditors needs assurance. So in order to avoid their complexities, so what Genpact itself will do, they will appoint one auditor, not for the statutory audit purposes. They will appoint one auditor exclusively to verify internal controls which are going to have an impact on user entities financial reporting. So this EY will verify internal controls which are implemented at the Genpact to do that outsourced activities, and they will give a report on that internal controls, so that that report can be used by the user auditor. In our example, Deloitte will use that audit report. By that, they will determine whether controls at the service organization are working effectively or not, and accordingly they can complete the audit of the user entity. So now they are talking about this EY. So if EY has to do this engagement, whether internal controls at the Genpact are working effectively or not, on this EY has to do the verification and give a report. Now how EY should do this engagement and how they should give the report, how they should give that assurance on the internal controls at the service organization, that guidance has been given under SAE 3402. That guidance where it has been given, that guidance has been given under SAE 3402. Able to understand? So this entire standard SAE 3402 is talking about how EY, in our example, how EY, this EY will be called as service auditor. EY will be called as what? Service auditor. So how this service auditor EY should verify this internal controls and give an assurance report. So that guidance has been given under SAE 3402. Hope you are able to understand what is the scope of this engagement. Next. So one more thing which we have to understand before we go for further guidance, SAE 3402 says that service auditor, whatever reports he will give, those reports can be divided into two categories. One is type 1 report, other one is type 2 report. Sir, what is type 1 report? In the type 1 report, what information will be there? See, first thing, what will happen is the management of the service organization, they will give one description. So management of the service organization, for example, Genpact will give one explanation, will give one detailed information in which they will explain what kind of controls they have, how the controls are functioning in their organization. Like that, first management will give details regarding their internal control system. Now in that detailed analysis, in that detailed information, they will make certain assertions. They will make written assertions. Number one, they will confirm that they have included in the description only actual position. So whatever actually happening in their organization, that only they have included in that description. Number two, they will also give a description that they have designed all the controls properly. They will make a statement that we have designed all the controls, whatever we have agreed with the user entity. And they will also make a written assertion that they have implemented all the controls properly. So first, management of the service organization, they will give one description, they will give one detailed statement in which they will describe what kind of controls are there in the organization. Then in that report, they will make some written assertions. They will give some written confirmations. What written confirmations they will give? Whatever we have explained in this statement, that is actually existing. We did not made any wrong statements. Whatever control system is there, that only we have explained. Number two, whatever controls we have agreed with the service organization, with the user entity, that controls we have designed properly. Whatever controls we have designed, that we have implemented properly. So that management will give a written representation, written confirmations they will give. Now this service auditor, in our example EY, now EY is going to verify this description and he will give a assurance. He will perform various kind of test and he will give a assurance whether really management has described what is actually existing, whether really management has really designed that controls, whatever they have agreed, and those controls are actually implemented or not. That auditor, that service auditor will verify and give a assurance report. And these are all as on specified date. As on what? Specified date. So whatever description management has given, that fairly represents the actual position as on specified date. Whether whatever controls that service organization has agreed with the user entity, they are actually designed as on specified date. And whatever controls which are designed that are actually implemented as on the specified date, that assurance will be given. So that report we call it as type 1 report. Now in the type 2 report, what will happen is, here also management will give description. Here also management will describe what kind of control system is there in the organization. Which management? Service organizations management. In our example, Genpact. Genpact will give a description what kind of control system is there in their organization. They will describe in a detailed manner. Here also they will give written assertions. Here also they will give an assertion whatever description we have given, that is fairly we have given it. Whatever is actually existing, that has been fairly described. Number two, we have properly whatever controls we have agreed with the user entity, that we have designed properly. Whatever controls we have designed, that we have implemented properly. And not just that, management of the service organization also will give a confirmation that those controls are operating effectively. Whatever controls we have implemented, those controls are operating effectively for a specified period. For a specified period. So here in the type 2 report, one more thing will get added. In the type 1 report, management will make assertion regarding descriptions fairness. They will also give assertion regarding designing of the controls. They will also give assertion regarding implementation. But in the type 2 report, the management will give a description. In that they will give an assertion, they have described fairly, controls are designed properly, controls are implemented properly, and even they will make an assertion that controls are operating effectively. Now the service auditor, in our example EY, he will actually verify all that report. He will verify whether really controls are described fairly, whether they are designed properly, whether they are implemented properly, and whether they are operating effectively or not. He will perform test of controls also, and he will give a report. He will give a report. That report we call it as type 2 report. So main differences between type 1 report and type 2 report is, in the type 1 report, the management will describe only regarding three things: description, fair description, designing, implementation. And auditor also will give a report only on fair description, implementation, and designing. But in the type 2 report, management will give a written confirmation that even controls have operated effectively also, and even auditor will verify whether really controls are operating effectively or not. Understood? So like this, depending on the engagement, either service auditor might give a type 1 report or he might give a type 2 report. And one more point of difference, type 1 report will be as on specified date, whereas type 2 report will be for a specified period. So like this, two reports can be given. Understood? So we understood what is the scope of this SAE 3402, what does it talk about, and also what kind of reports will be given by service auditor. So if at all you are a practicing chartered accountant and one service organization is coming to you and they are asking you to do this engagement, to verify their internal controls which are there in that service organization and give an assurance report, either type 1 or type 2, how you are supposed to perform that engagement, that all guidance has been given here. So let us have a look at it, how to perform that engagement. How to perform that engagement, let us see. Next one. So all this we have already covered, type 1, type 2, everything I have explained in a proper manner. So now let us try to understand how you are supposed to do that engagement. We'll come to the main point. First one, here you have to comply with the ethical requirements, like the way we comply with the ethical requirements, like in integrity, objectivity, confidentiality, professional competence and due care, professional behavior, even independence also. Why? Because in this engagement also we are giving assurance. Even when you are appointed to verify internal controls, there also you are giving assurance. So we have to comply with all ethical requirements, including independence. Check whether you are able to comply with that ethical requirements, including independence or not. That we have to do. Number one, you might be required to communicate certain matters with management and those charged with governance. So first try to identify in the organization who are management, who are those charged with governance, and if at all there are any communication requirements, fulfill all that communication requirements with the management and those charged with governance. Then you have to agree, accept and changes in the terms of engagement. So basically here also you have to draft the engagement letter. You need to have certain terms and conditions, under what terms and conditions you are required to do that engagement, what are management responsibilities, what are auditors responsibilities, that is practitioners responsibilities. So draft a engagement letter, and you have to get that engagement letter signed by the client as well. And here one more thing we have to remember, see in the audit what we do. In the audit, auditor will try to verify whether the financial statements are as per applicable financial reporting framework. This is what we do in audit, right? In audit, we generally verify, our objective is, auditor is going to verify whether financial statements are prepared as per applicable financial reporting framework. But in this kind of engagement, in SAE 3402, here what will be your responsibility is, here we call him as practitioner. So a practitioner should verify whatever description which has been prepared by the management regarding internal controls, whether it is as per applied criteria or not. Whether it is as per applied criteria or not. Same, in audit, whatever we do, we will replace them. In audit, auditor is going to verify whether financial statements are as per applicable financial reporting framework. But here, in this kind of engagement where we are required to verify internal controls, we need to verify as a practitioner. Here we call ourselves as a practitioner. So as a practitioner, we need to verify whatever description management has given, whether it is prepared as per applied criteria or not. In audit, we verify whether applicable financial reporting framework is acceptable or not. But here in this kind of engagement, we verify whether applied criteria, whatever management has used in the description of that information, whether that is acceptable or not. If it is acceptable, we will verify, we will accept the engagement. If the applied criteria is not acceptable, we should not accept that engagement. Understood? And few more things they say here. In case, for example, when you are appointed to do that engagement, initially we will draft an engagement letter and we will agree on all the terms and conditions. After you have accepted the engagement, then if the client is coming to you and asking for you to change the terms and conditions of the engagement, should you accept it? You should do it only when there is a reasonable justification. If there is reasonable justification, you accept it. If there is no reasonable justification, don't accept it. Same like whatever we have seen in normal audit terms only. So 3 points I have told how such engagement will be performed. You have to comply with ethical requirements. You have to determine who are management and those charged with governance and communicate with them. And you should determine the terms of the engagement and draft the engagement letter and get them signed. Then you have to determine suitability of the criteria. As I have told, on whatever criteria the management has prepared the description of the internal control system, is that criteria suitable? Is that criteria acceptable or not? You need to determine. Then after that, you need to determine materiality, like the way we determine materiality in the audit of the financial statements on the similar norms. We need to determine which controls are material, which controls are not material. That also you have to determine. Then you need to obtain an understanding of the service organization system. So first, overall, you need to obtain what kind of system, what kind of internal control system service organization is having. Try to obtain an overall understanding, basically risk assessment procedures. Then whatever description management has given, I told management will describe, no? So regarding that description, you try to obtain evidence. You perform procedures and try to obtain evidence whether management described that controls in a fair manner or not. Then you need to obtain evidence regarding design of the controls, whether the controls are designed properly or not. You obtain audit evidence. And you need to obtain audit evidence regarding operating effectiveness only in case of which report? Only in case of type 2 report, you need to obtain audit evidence regarding operating effectiveness of internal controls. If you are appointed to give only type 1 report, no need to obtain audit evidence regarding operating effectiveness of internal controls. If you obtain evidence regarding description of the system, if you obtain evidence regarding designing and implementation, you will be done. But in case if you are appointed for giving a type 2 report, then you should perform even test of controls to verify the operating effectiveness of internal controls as well. And also try to understand whether the service organization is already having an internal audit function. So if internal auditor is already there in the service organization, then as a service auditor, you will be at advantage. You can go and speak with the internal auditor to understand what findings internal auditor had regarding the controls. Then even you need to ask some written representation. As a service auditor, you need to ask some written representations from the management. So what written representation you should ask? Number one, to reconfirm the assertions accompanying the description. So whatever management has described, whether they are correct or not, ask the management to give a written confirmation. And also you should ask the management to give a written confirmation that it has provided the service auditor with all relevant information. Whatever information that is required by the service auditor, all that information has been provided, nothing has been hidden. Ask the management to give a written representation. And also ask a management to give a written representation that they have disclosed to the service auditor, if at all, if any of the below things happened. Like if there is any non-compliance, they should not hide it from the service auditor, they should have communicated. If there are any deficiencies in the internal controls, that the management should have voluntarily come and communicated with service auditor. And instances where controls have not operated, if the controls did not operate, that information has also been communicated with service auditor. Any events subsequent to the period covered by the service organization description of its system up to the date of the service auditor's assurance report. Basically, if there are any subsequent events, regarding that subsequent events also management has communicated. Basically, management did not hide anything from the service auditor. They told everything to the service auditor. Get that confirmation, not just in oral format, get that confirmation in the written format. And if at all any subsequent events are there, you try to perform procedures regarding that subsequent events as well. So these are all the various steps which you need to perform in case if you are appointed for doing that engagement. So once you are done with all these procedures, you are required to give a report or not. You are required to give an assurance. That assurance should be given in the form of a written report. How that report should be prepared? So that guidance has also been given. So what should be the contents of the assurance report? Number one, you have to give an appropriate title. Then you have to add one addressee. Then you have to identify service organization description of its system. So whatever management has given a description, describe that in your report. And also in case whether you are giving type 1 report or type 2 report, that also you explain. And those parts of the service organization which are not covered by service auditor's opinion. See, you will not verify as a service auditor, you will not verify all the controls at the service organization. This you have to remember. As a service auditor, you will verify only those controls in the service organization which have an impact on the financial reporting of the user entity. Very, very important point. As a service auditor, you will not verify all internal controls at the service organization. You will verify only those internal controls at the service organization which are having an impact on the financial reporting of user entity. In our example, I will verify internal controls which are there at the Genpact, which are going to impact the financial reporting of the Infosys. Clear? Next. If there are any complementary controls, you need to explain what kind of complementary controls are there at the user entity level and add a clear line that your report does not include verification of complementary controls in the user entity. Now, what are these complementary controls? See, complementary control means, let me give you one example. So in our example, Infosys has outsourced payroll activity to whom? To Genpact, right? To do this payroll activity, Genpact will have some controls. At the Genpact organization, they might have implemented some controls. So here in our example, EY service auditor will verify those controls which are there at the Genpact. But before this, Infosys has outsourced this payroll activities, there will be some complementary controls on the Infosys side also. There will be some complementary controls. Like for example, before sending the payroll data for Genpact for the purpose of processing, that payroll data should be approved by the payroll head at the Infosys. So this is one control which Infosys has set in the Infosys organization, which will be complementary, which will make this outsourcing activity even more better. So this control, we call it as complementary control. See, as a service auditor, when you are verifying internal controls, only controls at the service organization will be covered in your report. You will not verify complementary controls which are there at the user entity level, that you have to clearly describe in your report. So as a service auditor, we are not going to comment on complementary control that are existing at the user entity level. So mention that clearly. So that is what they say here. So that one line also you have to add in your report. Then after that, what will be the next content? So after that, if the services are performed by sub-service organization, then the nature of activities. See, this is what is the meaning is, sometimes what will happen is, Infosys has outsourced the activities to the service organization, which is Genpact. Now, sometimes what Genpact will do, no, they will further outsource the same activity to some another organization, some X Limited. So now this will be called as sub-service organization. So Infosys is a user entity. They have outsourced the services to Genpact, which is a service organization. They have further outsourced that activity to another entity, X Limited. Here it will become sub-service organization. So in case if you have if the service organization has outsourced these services to sub-service organization, that fact also you have to mention. Clear? So that's what they say here. If you come to here, if the services are performed by a sub-service organization, the nature of activities performed by the sub-service organization as described in service organization description of the system. What activities are performed by sub-service organization that you need to include in the report. So basically, we are talking about the contents of the report. First, there should be title, there should be addressee, then there should be identification of few things. After that, identification of criteria, according to which criteria the management has prepared that description, explain that as well. And also you need to describe test of controls, how you have tested the internal controls, that you have to describe. But you have to be very careful, this test of controls are required to be included only in type 2 report. Why? Because we comment on effectiveness of controls only in the type 2 report. If you are performing type 1 report, no need to explain any test of controls, because you will not perform any test of controls in type 1 report. You are not required to comment on operating effectiveness. And also you need to add one more line regarding responsibilities of the service organization. So what are the responsibilities of service organization? They are responsible for preparing a description of the system. They are responsible for providing the services, whatever they have agreed with the user entity. They are responsible for stating the control objectives, what kind of controls they are required to implement, that is their responsibility. And finally, they are responsible for designing and implementing controls. In case of type 2 report, you should also say that they are responsible for making the controls effective. And so after you have explained the management responsibility, then you have to add one responsibility regarding yours also. So you have to say that your responsibility is to express an opinion regarding test of control, regarding description, regarding design, regarding implementation, and in the case of type 2 report, regarding operating effectiveness. Then you add a line that you are doing this engagement not as per your wishes, you are doing the engagement in accordance with the requirements of 3402, SAE 3402. Then give a brief summary of what kind of procedures you have performed. Give a brief summary of that as well, and particularly mention that there will be limitations of control. We know that no matter how effectively you have implemented internal controls, still we can't get absolute assurance regarding their operating effectiveness, because inherent limitations are there for internal controls. Let the reader also know about it. We have verified internal controls. To us they sound appropriate, but still those internal controls might contain inherent limitations, because of which they might not function properly. Let the reader be aware of it. So describe the statement of limitations of controls also. Then finally, you have to express your opinion. So in the case of type 2 report, if you are satisfied, you have to say that description fairly presents whatever is happening, and they are suitably designed, they are suitably implemented. And in case of type 2 report, you will say that those controls are operating effectively also. If it is a type 1 report, we will simply say management has given a fair description, they are also properly designed the controls, and they are properly implemented. So after including all that controls, then you have to mention the date on which you are signing. Then you have to put your signature along with the place of signature. And this is common information, we all know this. If you are giving type 2 report, in the type 2 report you should include one separate section after the opinion, where you have to explain all your test of controls, what test you have performed, what kind of test of controls you have performed to test the operating effectiveness of controls, that you have to include. But this is only in the case of type 2 report. Along with that, you should also clearly state which controls you have tested. If you have done it on sampling basis, which controls you have tested, which controls you have not tested, that also you explain. And if deviations have been identified, if you have identified any deviations in the controls, because of what circumstances those deviations happened, that also you explain. And the auditor shall report deviations even if done on the basis of test performed, the service auditor has concluded that related control objective was which achieved. Sometimes what will happen is there will be deviation in control, but still control objective will be met. Still you have to report that deviation. Even after the deviation also, your objective will be met, but still you should not skip that deviation. That deviations also you have to report it. So, but all this you are required to do only in the case of type 2 report, not in the case of type 1 report. Clear? And you will give modified opinion. When you will give modified opinion, if you find that description is not fairly presented, or the controls are not designed properly, or the controls are not implemented properly. If it is a type 2 report, controls are not operated effectively. In any of these circumstances, you will give a modified opinion. And finally, whatever things you have performed, whatever evidences you have gathered, whatever procedures you have performed, everything must be included in the documentation. Clear? So this is what regarding SAE 3402. If you ask me, along with SAE 3402, to a major extent, we have covered SAE 402 also. Clear, everybody? So with this, we are done with SAE 3402 also. Now we are left with only one more standard from the SAE series, which is SAE 3420, which is talking about how you are supposed to perform an engagement in case of pro forma financial information. Okay, so let us try to understand SAE 3420 now. So what does SAE 3420 talk about? So this also, first I will try to explain in simple way what all this standard talks about, then we will try to understand how to do that engagement. So if you could see here, this standard is going to talk about reporting on compilation of pro forma financial information. So what does this standard talk about? As a chartered accountant in practice, if you are appointed to give a report on the compilation of pro forma financial information, which is included in a prospectus, how you are supposed to perform that engagement. So here also, first we will try to understand what is the nature of this engagement. Take for example, there is a company X Limited. There is a company X Limited. Just now financial year 23-24 is over. For this financial year 23-24, they have prepared financial statements, they have prepared balance sheet, they have prepared P&L, they have prepared cash flow statement, they have even prepared statement of changes in equity and notes to accounts. So as on 31st of March 2024, all these financial statements are prepared and these are audited also. These are financial statements are all audited by some auditor also. Now on 30th of April 2024, the company X Limited decided that they will go for issue of shares. They will go for IPO. And this IPO is about to take place on 30th of September. They want to release that IPO. They want to make an IPO of their shares as on 30th of September 2024. They want to do the IPO. So that decision was taken on 30th of September 2024. They have decided on 30th of September that they want to issue shares to the common public on 30th of September. Now they have to release the prospectus. No, they have to release the prospectus for the issue of shares. So in that prospectus, they have to include something called pro forma financial information. Sir, what is pro forma financial information? Simply, this issue of the shares is going to happen on 30th of September. But the management, as on 30th of April itself, they will imagine what if this IPO has taken place on 31st of March itself. What if this IPO has taken place on 31st of March itself? If that IPO has taken as on 31st of March itself, how the financial statements are going to look like? How the financial statements are going to look like, that financial statements they are going to prepare. A future event which is going to take place, issue of shares is going to take place on 30th of September. What if that issue has taken place as on 31st of March only? How the financial statements would then look like? That financial statements will be prepared. That prepared financial statements, we call them as pro forma financial information. So basically what is going to happen here is we are taking an unadjusted financial statements. So unadjusted financial statements are financial statements for the financial year 2023-24. So whatever financial statements are there for the financial year 23-24, those are unadjusted financial statements. To that, we are making some adjustments. To that, we are making some what? Adjustment. What adjustments? We are imagining the issue which is about to take place in the future. What if that issue happens today itself? As on the balance sheet date only, if that issue is happening, what adjustments we will make? So that adjustments will happen. That we call them as pro forma adjustments. That we call them as what? Pro forma adjustments. So there is unadjusted financial statements, that is financial statements for the year 23-24. To that we will make pro forma adjustments, assuming that event which is about to take place in the future. What if it happens as on the balance sheet date only? We will consider that, do the adjustments, then we will get the resulting information which we call it as pro forma financial information. The resulting information we call it as what? Pro forma financial information. Now this pro forma financial information will be included in the prospectus. But this client has brought this pro forma financial information to you. You are a practicing chartered accountant. Client has brought this pro forma financial information before you, and they want you to verify that pro forma financial information and give a report giving your assurance on that pro forma financial information. giving your assurance on pro forma financial information. So if the client is coming to you and asking you to do that engagement, how you will perform that engagement of verification of pro forma financial information. That is what you are supposed to learn here in the standard SAE 3420. Able to understand the purpose of the engagement? Guys, if you get the purpose of the engagement, the content of the standard becomes very much clear. If you don't understand the purpose of the engagement, no matter how many times you read it, you will never be able to get it. But once you get the purpose of the engagement, the things will become so damn simple. I hope I'm able to give the clarity. What is the purpose of this whole engagement? Clear, everybody? So now how you are supposed to do this engagement, that's what all the standard is going to talk about. Clear, everybody? So let us have a look at the standard, how we are supposed to perform that engagement. Okay, and one more thing we have to be clear here. Let me tell you one more thing here. See, in normal audit, what we do? In normal audit, what we do is, as an auditor, we are required to verify whether financial statements prepared by management, whether financial statements which are prepared by management, whether they are as per applicable financial reporting framework or not. This is what we are supposed to do in the audit. So as an auditor, we are required to verify whether financial statements which are prepared by the management are as per applicable financial reporting framework. But in this kind of engagement, what we do is, in the engagement of pro forma financial information, what we do is, as a practitioner, we will verify pro forma financial information which is prepared by responsible party, whether it is as per applied criteria or not. The same thing, whatever we do in the audit, more or less the similar things we do, but we will replace. In audit, we will verify whether auditor will verify whether financial statements are prepared by the management as per applicable financial reporting framework. In this kind of engagement of pro forma financial information, what we basically try to verify is, as a practitioner, we will verify whether pro forma financial information which is prepared by responsible party is as per applied criteria or not. This is what we are supposed to do. Understood? So let us see how we are supposed to perform that engagement. So I have already told you what is the meaning of pro forma financial information. So what are the objectives of the auditor? If you are a practitioner and you are asked by some client to verify the pro forma financial information, what are your objectives? My objectives are, I have to obtain reasonable assurance whether pro forma financial information has been complied in all material respects by the responsible party on the basis of applied criteria. That's what I have told you now. And even you have to report in accordance with practitioners' findings. Whatever your findings are there, you are required to report. Guys, one more thing which I forgot to mention. See, if you are doing engagement of SAE 3400, when you are reporting on prospective financial information, you will give negative assurance. You will try to do your wording in a negative way. In case if you are doing engagement as per SAE 3402, here that means you are giving report on internal controls. Here you will give positive assurance. You will give what? Positive assurance. Like in SAE 3402, you are required to verify internal controls and give the report. No, if you are satisfied with the internal controls, you will say internal controls are operating effectively, internal controls are designed properly, internal controls are implemented properly, management has fairly described their internal control system. You give positive assurance in internal control assurance report. Whereas if you remember, in the prospective financial information engagement, we give negative assurance. Like we say, nothing has come to our attention which makes us believe that prospective financial information is improper. But when you are doing engagement as per SAE 3402, you can use a positive assurance. That means you can say, according to the information explanation given to us, internal controls are operating effectively, internal controls are designed properly, internal controls are implemented properly, and management has given a fair description of internal controls. These points are very important for MCQs. Same thing for SAE 3420 also. In SAE 3420 also, you can use positive assurance. You can give a positive assurance. In SAE 3420 also, you can give positive assurance. If you are satisfied, you can say, yes, the management has prepared the prospective financial information as per applied criteria. It is giving fair presentation. So you can give positive assurance even in the case of engagement done as per SAE 3420 as well. Right. So coming to the next part, it is whose responsibility to compile pro forma financial information. As I have told, the management, that is the responsible party, will compile the pro forma financial information and we are going to verify it. And what are the steps which a responsible party should follow in the compilation of that pro forma financial information? So first they have to identify source. First they have to identify unadjusted financial information. To that unadjusted financial information, you have to make pro forma adjustments. By doing that pro forma adjustments, you are going to get pro forma financial information. This is what even I have told. These are all the various steps involved. So you have to take unadjusted financial information. To that, you have to make pro forma adjustments. The resulting figure, whatever you are going to get, that we call it as pro forma financial information. So these are all the various steps which management has to follow in the compilation of pro forma financial information. Next one. So coming to the next part, this is the most important part from the standard. What are the various steps which are involved in doing that verification of pro forma financial information? Number one, you have to determine whether you can accept that engagement or not. First, you have to determine whether you can accept that engagement. If the client is coming to you and asking you to verify the pro forma financial information, you should determine whatever criteria the responsible party has used in the preparation of that pro forma financial information. Is it acceptable or not? Very similar to audit. In the audit, they say before you accept the audit, you need to determine whether applicable financial reporting framework is acceptable or not. On the similar lines, if the client is coming to you and asking you to verify pro forma financial information, first you need to determine whatever criteria they have applied in that pro forma financial information, whether that is acceptable or not. If it is acceptable, you accept that engagement. If it is not acceptable, don't accept that engagement. And here also, you need to draft a engagement letter. So before accepting the engagement, you need to determine certain things. You need to consider certain matters. Before you say yes to that engagement, you need to consider certain factors. First of all, whether you have capabilities and competence or not. Whether if the client is coming to you and asking you to verify the pro forma financial information, first you should decide, am I capable to do it? Do I have enough of team? Do I have enough of resources? Do I know how to do this engagement? So first you determine your capabilities. If you are capable, then accept the engagement. If you are not capable, don't accept that engagement. Unnecessarily, client will suffer. Next one. Then you need to determine whether applied criteria is suitable or not. I have already told you, this is one more thing which you have to consider. Then try to understand what is the opinion expected from you, what kind of wording the responsible party is expecting from you, whether that wording, is it possible to give it or is it not possible to give it. If the management is having very unrealistic assumptions regarding the opinion which you have to give, like for example, they are expecting you to give absolute assurance, that's the kind of wording they are expecting, you should say, no sir, I can't give that wording, I will better stay away from the engagement. And also, from which sources that unadjusted financial information is getting extracted. Like for example, what do you mean by unadjusted financial information? In our example, whatever financial statements are there for the financial year 23-24, actual financial statements, that is unadjusted financial statements. I need to determine, is it reliable or not. So whether this unadjusted financial information to which the pro forma adjustments are made, whether it is reliable or not. I need to check what kind of audit report is given for that unadjusted financial statements, whether these unadjusted financial statements are audited or unaudited. Whether these unadjusted financial statements are audited or unaudited. If they are audited, well and good, fine. Then I need to check in the audit report, is there an unmodified opinion or is there a modified opinion or emphasis of matter paragraph or other matter paragraph. So in some cases, what they say is, if the unadjusted financial statements is unaudited, you should not use it. Then there is no purpose of doing the engagement only. In some cases, the rules will say, if the unadjusted financial statements are audited, but that audit report contains modified opinion or that audit report contains emphasis of matter or other matter paragraph, then also you can't use that. Then also you can't use that unadjusted financial statements. Then also there is no purpose of accepting the engagement. In some cases, the unadjusted financial statements will be audited and that audit report will contain unmodified opinion. Then you can happily make the adjustments. Clear? So like this, you need to determine what is the status of that unadjusted financial information. Is it audited? Is it not audited? If it is audited, what information is there in the audit report? What kind of opinion is there? Whether this framework, whether this criteria permits to use that information, does not permit to use that information. So all that things you have to determine. Next. After that, even you need to check, this point I have already covered. If the entity's historical financial information has never been audited, in case if the unadjusted financial information is unaudited and there is no restriction, some frameworks, what they say, you can use unadjusted financial information even if it is unaudited. If that permission is there, you can use it, but here there will be one extra responsibility. You need to check once whether that unadjusted financial information is accurate or not. If it is audited already, the auditor will already mention in the audit report. If it is unaudited and if there is no restriction on using that unadjusted financial statements, you need to perform some procedures to check whether this unadjusted financial statements is appropriate or inappropriate. Next one. Sometimes you might be required to prepare pro forma financial information because of some acquisition. So when you are going for acquisition, then also pro forma adjustments will come. I will tell you one example to make you understand this also. Take for example, X Limited company is there. They have prepared financial statements as on 31st of March 2024. On 30th of April, they have decided that they will acquire Y Limited. They will acquire Y Limited on 30th of September. So now what you should do is, here also some prospectus, some documents will get prepared. Now what the management will do is, they will imagine as on 30th of September, what if that acquisition has taken place as on 31st of March 2024, how the financial statements will look like. Here also they will take unadjusted financial statements. To that they will make pro forma adjustments. Here pro forma adjustments will be imagining as if that acquisition has taken place as on 31st of March only. So they will do the imagination, do that adjustments, and prepare pro forma financial information. See, in these kind of engagements, you need to determine whether you will be given access to verify the data of acquiry. That is, this acquiry means the entity which is getting bought. So in case of these kind of pro forma financial information, you might need access to this acquiree's books of accounts also, acquiree's financial data also. Whether that access is available or not, that also you have to determine. And then you have to obtain written agreement from the responsible party. You need to get a written confirmation from the responsible party that they will disclose, that they have adequately disclosed and described the applicable criteria. They are the one who are responsible for compiling the pro forma financial information. They have to provide the practitioner with access to all information. Any additional information which the practitioner might require, they have to give the access to the persons within the entity from whom the practitioner can obtain required information, and where needed, access to appropriate individuals within the acquiry. Like I told now, just now, in the acquiree's organization also, you might need access to the people. Basically, these are all nothing but in SA 200, whatever they say preconditions for audit, same preconditions are there. Just they replace the term of auditor with practitioner, they replace the term management with responsible party. Everything else remains the same. Next one. And then finally, so once you have considered all these factors, and accordingly you will take the decision whether to accept that engagement or not. Once you have accepted the engagement, then you have to start doing that engagement. So you will spend some time on planning, and you will actually perform that engagement. So how you have to plan and perform that engagement? So here also they have told various steps. First, you need to determine whether applied criteria is suitable or not. Here also you need to determine materiality, what is material, what is not material, and you need to obtain understanding how the responsible party has compiled that pro forma financial information. Then you need to obtain appropriateness of the source in the sense unadjusted financial information, whether that unadjusted financial information is appropriate or not, that you need to determine. In case if the unadjusted financial information is unaudited, as I have told, you need to perform some procedures to determine whether that unadjusted financial statements are accurate or not. Then you need to determine whether responsible party has appropriately extracted from that unadjusted information, properly information has been extracted or not. Then you need to obtain sufficient and appropriate evidence regarding adjustments, whether they have done adjustments properly or not. And whatever pro forma financial information is there, that should be consistent with the applicable financial reporting framework. Basically, whatever Schedule 3 accounting standards are there, according to that format only pro forma financial information also should be prepared. Regarding that, you need to obtain audit evidence, and overall you need to evaluate the presentation, whether they have done the presentation properly or not, and even you need to check the consistency with other information. So in the prospectus, if some other information is also there, that other information should be consistent with pro forma financial information. Those things also you need to check. Then you need to obtain some written representations. These are common. This you can refer it. And finally, opinions you are required to give. So here also the same thing. If you are satisfied that pro forma financial information is proper, it has been presented properly, adjustments are also done properly, you can happily go ahead and give the unmodified opinion. But as I've told, here you are permitted to use positive assurance. So you can say that pro forma financial information has presented fairly in all material respects. You can use positive wording. Now, sir, what if in the pro forma financial information something is wrong? Right. So here there is certain things you need to understand. So you performed procedures on the pro forma financial information, and you found that something is wrong with the pro forma financial information. So if something is wrong with the pro forma financial information, you have to give modified opinion. You have to give modified opinion. But in some cases, law and regulation will say that in the prospectus, you should not include pro forma financial information which contains a modified opinion. You are required to give modified opinion. You have verified pro forma financial information. You found something wrong in the pro forma financial information. So you have to give modified opinion. But sometimes law and regulation will say in the prospectus, there should not be pro forma financial information which contains a modified opinion. You will give modified opinion, but that information will not go in the prospectus, then what you should do? So that's why if that restriction is there, if the law or regulation is prohibiting from including pro forma financial information which contains a modified opinion, then what you should do is, first you should ask the management to make the changes. Ask the management, sir, please change it, change the information, give a proper information so that I can give unmodified opinion. If the management is not making any changes, what you will do? You have to withdraw. If the management is not making changes, what you should do? Withdraw from the engagement. Sir, why I have to withdraw? Why can't I proceed ahead and give the modified opinion? Why? Because even if you give the modified opinion, law and regulation is restricting you not to include that information in the prospectus. So then what is the purpose of continuing the audit? So that's why, in case if you find something wrong in the pro forma financial information, before you give modified opinion, check, is there any restriction in the law and regulation to not include that pro forma financial information which contains modified opinion. So if that restriction is there, ask the management to make the changes. If they are not making the changes, withdraw. There is no purpose of giving a modified opinion here. However, if there is no such restriction, law or regulation did not put any restriction that only pro forma financial information which contains unmodified opinion should be included, which contains modified opinion should not be included, that restriction is not there, then what you can do is, then you can proceed ahead and give the modified opinion. Why? Because here there is no restriction from the law not to include that pro forma financial information which contains modified opinion. So if that restriction is not there, continue the audit, give the modified opinion. But however, if that restriction is there, first give the opportunity for the management to make the changes. If they are not making the changes, withdraw, don't proceed with the audit and give the modified opinion. Understood? So this is what regarding opinions. And then finally, there should be some contents in the report. Finally, whatever report you give, in that report there should be a few contents. So title should be there, addresses should be there. Then you have to include one introductory paragraph, so in which you have to identify what is the pro forma financial information, from which source you have got that unadjusted financial information, for what period you have done the adjustments, and even reference to applied criteria, what criteria you have applied. Then you have to explain the responsible party. What is the responsible party's responsibility? They have to compile the pro forma financial information. Then you have to explain your responsibilities. So those responsibilities are given here, which you can refer. Then you have to add one line that you have performed the engagement as per SAE 3420, not as per your own wishes. Then you have to add a few statements like this engagement is a reasonable assurance engagement, where you are going to report whether pro forma financial information is as per applied criteria or not. And even you have to explain what procedures you have performed using your professional judgment. And also you have to say that as a part of this engagement, you have evaluated whether overall presentation is proper or not. And then finally, you have to sign, you have to mention the date and place of signature. Documentation requirements are going to be common. Clear, everybody? So this is what regarding SAE 3420. So with this, we have successfully revised all the 3 SAE series of the standards. Hope you guys are able to derive some value out of it. So bye everybody. We'll see you in the next video with the next chapter.